A $25 billion Treasury auction just bombed. Foreign demand collapsed to 58.9%. Yields spiked, and global investors are backing away from U.S. debt. At the same time, Trump slashed tariffs on China from 145% to 80%. No deal, no concession, just a sudden reversal handed off to Besant under market pressure. Inflation's rising, the bond market's flashing red, and Washington is making unilateral moves that even allies don't understand. So here's the question. If no one's buying what America's selling, what happens next? Why did America just pay more to borrow and get fewer takers? On May 9th, the U.S. Treasury's 30-year bond auction closed with a yield of 4.82%, significantly above market expectations. According to Bloomberg, foreign demand, measured by indirect bids, plummeted to 58.9%, a steep drop from the 6-month average of 64.1%, signaling a loss of confidence among global investors. The Wall Street Journal reported that primary dealers were forced to absorb a larger than usual share, suggesting hesitance even among allies like Japan, which had just dumped $36.6 billion in treasuries in March alone. The timing wasn't coincidental. This auction came just days after Trump reaffirmed 145% tariffs on Chinese imports, heightening fears of prolonged inflation and retaliatory disruptions in supply chains. As yields climb, so does the cost of servicing America's record $34.6 trillion national debt, already projected by the CBO to consume over $1 trillion in interest payments by 2025. But this wasn't just a failed auction. It was a flashing red light that the global market may be preparing to step back from financing Washington's trade war. Just 72 hours after the auction collapse, Trump floated a new number, 80% tariffs on Chinese goods, down from the previously imposed 145%. But this wasn't a negotiated shift. It was an unprompted social media post, followed by a pointed comment. "It's up to Scott B." That single sentence effectively delegated a $1 trillion reversal to Treasury Secretary Scott Bessent, without public discussion or strategy briefings. Reuters reports that this pivot blindsided not only investors, but also members of Trump's trade team. Meanwhile, China's Vice Foreign Minister Hua Chunying responded coolly, stating that Beijing has full confidence in managing U.S. pressure, offering no reciprocal gesture, no counter rate, just silence. Dan Wang of the Eurasia Group told the BBC that the signal was less about tariff calibration and more about internal economic distress inside the White House. If so, then the proposed 80% figure wasn't an olive branch. It was a tactical retreat disguised as policy, and it leaves one critical question unanswered. If Trump's strategy is so effective, why is he the one blinking first? April trade data from China's General Administration of Customs reveals a paradox Washington has yet to resolve. While exports to the U.S. dropped 21.2% year over year, China's overall exports surged 8.1%, beating expectations and generating a record $96 billion trade surplus. According to Bloomberg Economics, the growth was led by a 23% increase in shipments to Southeast Asia, and an 8% rise in exports to the European Union. The numbers show that China is not merely dodging tariffs, it's expanding market share elsewhere. Experts point to a structural pivot, where Chinese firms reroute goods through intermediary countries or shift to non-US markets entirely. Eswar Prasad, former head of the IMF's China division, explained that China's adaptability is undermining the foundational logic of U.S. sanctions. That adaptation is now capitalized into industrial resilience. The question haunting American trade officials isn't whether the U.S. is hurting China, but whether it's hurting itself more. U.S. officials continue to tout reshoring as the antidote to dependency, but customs data suggests it's mostly a mirage. In the first quarter of 2025, Vietnam imported $30.2 billion worth of Chinese goods, a 26% jump from the same period last year. Simultaneously, its exports to the U.S. soared, raising concerns of transshipment, a practice where Chinese origin goods are relabeled in third countries to avoid tariffs. The Peterson Institute notes that such indirect trade may now account for up to 40% of Southeast Asia's US-bound exports. And that's just the physical goods. The material story is worse. China has cut exports of gallium and germanium by 16%, shrinking total global supply and inflating costs for industries from EV batteries to missile systems. U.S. rare earth dependency, still over 80% sourced from China according to the USGS, isn't fading. It's being outsourced through costlier and more volatile channels. The more Washington tries to pivot away, the deeper it sinks into hidden entanglements. On May 8th, during a heated House Financial Services Committee session, Bessent was asked directly, who pays tariffs? His answer, it's complicated, but markets don't tolerate ambiguity. That moment, clipped and broadcast by CNBC, sent financial sentiment spinning. According to FactSet, the VIX Volatility Index spiked 7.4% in the following 36 hours. The S&P 500 gave back gains, closing down 1.6% on tariff news that should have triggered a rally. The bond market, already reeling from poor auction uptake, priced in additional risk premiums, with the 10-year yield climbing to 4.39%, its highest level since November. For analysts like Stephen Olson, former U.S. trade negotiator, Bessent's inability to articulate tariff mechanics reinforces global skepticism about U.S. trade coherence. The damage isn't theoretical, it's active. Investor trust is eroding in real time, not because of ideology, but because the person in charge can't explain the math behind the policy. And the debt market is no longer willing to give Washington the benefit of the doubt. In April 2025, China slashed its global rare earth exports by 16%, shipping just 4,812 metric tons, according to official customs data, marking its lowest monthly total since 2019. The cuts hit gallium, germanium, and antimony. The hardest, minerals the U.S. Geological Survey confirms are essential for semiconductor manufacturing, electric vehicles, and missile guidance systems. Bloomberg reported that China's Commerce Ministry targeted these materials under updated export controls, citing national security. Meanwhile, U.S. manufacturers reliant on neodymium magnets for EV drivetrains are paying 28% more per kilogram than they did 6 months ago. The Department of Defense acknowledged in April that 83% of its strategic mineral imports come from China or Chinese-controlled assets in Africa. Treasury Secretary Scott Bessent is now under pressure in Geneva to negotiate rare earth relief as part of tariff de-escalation talks. But Beijing has signaled any concessions will hinge on full tariff rollbacks. So the U.S. enters negotiations asking for critical materials, while still imposing 145% import duties. How does that deal close? On May 7th, Trump surprised markets by proposing an 80% tariff on Chinese imports, down from the 145% he imposed just weeks earlier, but offered no diplomatic context. Only writing seems right and shifting responsibility to Bessent. The move followed 3 straight weeks of weak bond auctions and a Reuters report showing freight costs for U.S. retailers jumped 22% in April, as companies scrambled to replace disrupted Chinese supplies. Yet, China's Ministry of Commerce did not respond in kind, instead reiterating its position that any negotiations must begin with full U.S. tariff withdrawal. Former IMF China Director Eswar Prasad noted on Bloomberg TV that a unilateral cut without reciprocity signals. Washington is reacting more to inflation pressure than geopolitical leverage. Inside Geneva, Bessent now faces an awkward contradiction. His side appears to be negotiating with itself, while Beijing waits for a better offer. If this is a bluff, it's an expensive one. Trump's May 6th announcement of a new trade deal with the UK drew headlines, but the numbers behind it suggest it's more photo op than turning point. According to the Office of the U.S. Trade Representative, the UK accounts for just 2.9% of U.S. trade volume. And while the deal allows tariff-free Rolls-Royce engines and expanded beef access, it also raises the average tariff on British goods from 3.4% to 10%. The agreement does open $5 billion in new U.S. agricultural exports. Per Commerce Secretary Howard Lutnick, and British Airways did announce a $10 billion Boeing order. But these gains are offset by the 90-plus nations still facing upcoming tariff hikes. China among them. As Stephen Olson, former U.S. trade negotiator, told Reuters, "This deal works with allies. It doesn't translate to adversaries with leverage." Framing this as a template for China is not just premature, it's structurally flawed. Howard Lutnick offered an unexpected glimpse behind the curtain when he said the administration may settle tariffs with China at 34%, calling it a human level that lets us do business. That number isn't random. Trump first floated it during his 2019 tariff campaign, which the Tax Foundation then estimated would shrink U.S. GDP by 0.8% annually if sustained. Compared to today's 145%, 34% looks modest. But it still quadruples pre-trade war baselines. The Peterson Institute warns that even a 34% rate across strategic goods could add 1.3% to core inflation and reduce global trade volume by $430 billion annually. More importantly, it wouldn't prevent circumvention via Southeast Asia, where Chinese inputs are re-exported to the US with minimal oversight. So the real question isn't whether 34% is politically viable. It's whether it's economically coherent in a supply chain world that no longer respects borders. Scott Bessent entered Geneva asking for mineral access while defending tariffs that cut off supply. China walked in selling goods at a record surplus, despite sanctions, and without begging for relief. And now the US stands between two accelerating crises, a bond market testing its breaking point, and a trade war strategy showing visible cracks. The 80% tariff? Still unofficial. The 34% compromise? Not guaranteed. But the debt auctions aren't waiting, and neither is inflation. So here's the real cliffhanger. What happens if China doesn't blink? Again, and this time, the buyers of US debt don't either. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.